Hi, Mike Chikrim here. I'm an investment advisor with Nor Private Wealth. If you're a Canadian business owner or an incorporated professional such as a doctor, lawyer, or accountant, then this video is for you. Chances are you currently have retained earnings sitting in a corporate checking account earning nothing. Or maybe that money is invested, but the new rules on corporate money earning passive investment income have you worried. If you do, taking that money out of the corporation is a taxable event that is costly. And perhaps that is why you still have that money there. If that money accumulating in your corporate account is ultimately for retirement, then there's a lot of benefit to transferring it tax-free to an individual or personal pension plan. Yes, I did say tax-free. It is actually a little known secret that has been around a long time. The strategy is to open what is called an individual pension plan or a personal pension plan and register it with the CRA. Once that is done, a registered pension plan will be established that is similar to a defined benefit pension plan offered by a large corporation. As you know, anyone with a pension plan knows what their retirement income will be based on their years of service and a final average income level. What makes them really happy is that it is guaranteed as long as they live. It is very comforting to have that security of a pension plan in place. Now, in order for a company to fulfill this pension obligation, it is required to properly fund the plan for its employees. The CRA uses a formula that effectively has a higher contribution rate than an RRSP. And it is this difference that creates the opportunity to transfer substantial amounts of money out of your corporation tax-free. You see, the pension needs to be funded by the corporation to ensure that it can pay you a guaranteed income from the day you retire until the day you die. To give you an idea of how high the difference is, a 40-year-old earning in excess of $151,000 would be able to contribute $2,000 more than the current RRSP maximum. At age 50, approximately $8,000 more. And at age 60, about $15,000 more. Not only can you contribute more each year, but you can go back to the time that your company was established to recapture the unused contribution room. And in many cases, this is hundreds of thousands of dollars that can be moved out of your corporation tax-free to fund the unused room. So when your corporation funds the pension, it is considered an expense. Thus, you can lower your corporate tax to the extent of the unfunded amounts each year. And this is quite powerful if you think about it. If you have a lump sum to fund, your corporation can go back 3 years and redo its tax return and even carry forward those four losses that result from the unfunded amount. Also, each year, taxes will be lowered by the pension expense. There are other benefits that make this a great solution for business owners who find traditional RRSPs restrictive. So let's say you only have an RRSP and you die. Only your spouse can receive a tax-free rollover of your RRSP account, avoiding income taxes on your terminal return. If both you and your spouse die and that money goes to your children, then the entire value of your RRSP is considered income earned in the year you die. That RRSP income is added to any other income that you have earned and taxed at your marginal tax rate, which is the highest tax rate. Your named RRSP beneficiaries receive the amounts willed, but the estate has to pay the income tax. If your money is transferred into an individual pension plan, that money will remain in the pension pool as a surplus when you die, and will be passed on to members, family members who are members of the pension plan and who earn an active T4 income from your corporation. So this is a very, very good estate planning strategy, and you can have surplus money passed from generation to generation in the plan tax-free. Another advantage over an RRSP is that administration and investment management fees are tax deductible. So this reduces the cost and allows you to keep more of the returns in your plan. And what if the pension has a bad year? Well, the corporation will need to fund the plan to make up the difference, which is, by the way, calculated on a 7.5% annualized rate of return. So let's say you experienced a 2.5% rate of return 1 year. It means your corporation will need to fund the difference of 5%. And because the corporate tax rate is usually higher than the target rate of return, most business owners will purposely make their portfolios more conservative. And this allows for more money to be transferred out of the corporation tax-free. So those are the main benefits. There are more, and I encourage you to read the materials that I've provided here. If you'd like to find out if this can benefit you, there's a questionnaire that you can fill out that will be submitted to the plan administrators to show you how much you can save. But it is best to schedule a call with me so I can go over your situation a bit so I can understand more about you. All right, so I hope to hear from you soon.